welcome to Iron Financial, the channel where we forge stronger portfolios by cutting right through all that market weakness. Today, we are putting core and main under the microscope. Ticker is CNM. They just dropped their Q4 earnings, and let's just say the market's reaction was fast and it was brutal. So we're going to do what we do best. We're running a full stress test on these numbers. We're going to look for any and all cracks in the foundation and figure out if there's a bedrock of real value hiding under all that noise.
Yeah, let's just cut to the chase, right? The market took one look at this report and just slammed the sell button. So the only question that really matters for us today is this a real problem? Are we looking at a fundamental crack in this business, a deep structural flaw that actually justifies this kind of panic selling? Or, and this is the big or, is this just a classic market overreaction? Is this a bedrock opportunity for those of us who are willing to pick up the tools and do the heavy lifting, the real analytical work? This is what we're here to figure out. Is it a trap? Or is it a fortress that just went on sale?
Okay, so here's the game plan. This is how we're going to get our answer. First, we've got to look at the market's gut reaction, see what really spooked everybody. Then we're going to deconstruct the revenue engine, do a full integrity check on their sales. Third, and this is the big one, we have to solve the profitability puzzle. You know, how can profits be soaring when sales look like they're hitting a wall? After that, we'll scrutinize their blueprint for 2026. That's the forward guidance. And finally, we will deliver our verdict. Let's get our hands dirty.
Okay, Section 1. Let's get into it. Before we start digging deep into the foundation, we really need to understand the surface fracture. We need to know what the market saw and why it reacted with so much force. This is all about that immediate sentiment, the headline numbers that triggered the initial sell-off.
And boom, there it is, Exhibit A, a 6.3% drop in the stock price right after the announcement. In the short term, the market is just a big voting machine, and this was a very, very decisive vote of no confidence. It doesn't really matter what kind of nuance is buried deep in the report. When a stock gets hammered like this, it tells you that the big players on Wall Street saw something they really, really did not like. Now, our job is to figure out if they're right or if they just got spooked by a shadow. That number tells us the what, now we got to find the why.
And here's where things get, well, weird. This is the source of all the confusion. The data is literally pulling in two completely different directions. On one side, you have misses where it really hurts. Top-line Q4 revenue. It came in light. It missed expectations. And even more critically, the full-year guidance for 2026, also a miss. And the market hates weak guidance. That's a cardinal sin. For a lot of traders, that right there is enough to justify the sell-off. But then you look at the bottom line. Adjusted earnings per share, or EPS, didn't just beat expectations, it absolutely demolished them. We're talking by almost 58%. So what we have is clear weakness at the top, but incredible, undeniable strength at the bottom. This is the puzzle we have to solve.
All right, Section 2, we're going deeper now. We're moving past the headlines to run a full integrity check on the revenue engine itself. Is the company's ability to generate sales fundamentally strong, or is it starting to show some signs of serious rust? This is where the real analysis, the real work, begins.
So before we start dissecting this specific quarter, let's just establish a baseline here. The CEO, Mark Witkowski, he made a point of mentioning this for very good reason. 16 consecutive years of sales growth. Now that's not just luck, that's a fortress. It signals a resilient, durable business model that has survived multiple economic cycles and shocks. This is absolutely crucial context. We are not analyzing some fledgling startup here. We are stress testing a seasoned industrial powerhouse. That's great, but you don't get bonus points for history class. Past performance is no guarantee of future results, and that history doesn't grant them a free pass for what's happening right now. The only question is, what have you done for me lately?
And you know what? That's a fair challenge, because the recent trend is completely undeniable. If you look at the 5-year compounded annual growth rate, it was a blistering 16%. That's incredible for an industrial distributor, and it's the kind of performance that earns a stock a premium valuation. But just look at the last 2 years. That growth has decelerated all the way down to 6.8%. Now, you might call that a deceleration. I'd call it hitting the brakes and hitting them hard. The engine is still running, sure, but it has clearly lost some significant horsepower. That trajectory is pointing in the wrong direction. And this, right here, is the number that just stops you in your tracks. A nearly 7% year-over-year decline in net sales. Let's just be blunt about it. That's not a slowdown. That is a reversal. After hearing about 16 years of uninterrupted growth, seeing a number like this is a major, major red flag. This looks like a clear sign of weakening demand and a definitive break in that long-term growth story. It's the kind of number that makes traders hit the sell button first and ask the questions later.
But hold on. This is exactly why we do a stress test and don't just read the headlines.
If you dig deep into the press release, there is a critical detail that almost everyone is going to miss. Q4 of this fiscal year had one less selling week than the same quarter last year. Now that's a significant calendar disadvantage. When you actually normalize for that and look at the business on a true apples-to-apples basis, we're talking average daily sales, the whole picture just flips entirely. Okay, fine, I see the math. That nasty 6.9% decline transforms into a 0.9% increase. I'll grant you, the business isn't shrinking. But let's not break out the champagne for less than 1% growth. It proves stability, not strength. The foundation isn't cracked, but it's not exactly growing either. It's just flat.
And if we go one layer deeper, it actually reveals a pretty mixed bag. This isn't a story of universal strength or weakness. That modest growth in average daily sales, it came from real strength in their fire protection and their meters businesses, which both saw higher volumes. But, and this is a big but, look at the other side. Their core product lines, the pipes, valves, and fittings, and the storm drainage, they actually saw volumes decrease. That's a problem. The guts of their business, the things you think of when you think of this company, are showing weakness. They're basically being propped up by their other segments. And that tells me the foundation might be solid overall, but some key sections are going to require some serious reinforcement.
All right, so this brings us right to the core of the issue, the real mystery. How on earth can a company with decelerating, basically flat revenue post a monster beat on its profits? Is this some kind of magic trick? My gut is telling me this smells a lot like financial engineering, not genuine operational strength, and it's exactly the right question to ask. This is the profitability puzzle we have to solve, and the answer is going to tell us if this company is built of brick or if it's built of straw. This is the number that creates the puzzle. A nearly 58% beat on adjusted earnings per share versus what Wall Street was expecting. This is the wow factor. It's the data point that completely contradicts the entire narrative of a slowing business. It's a number so good it almost makes you suspicious, right? A company that appears to be struggling on the top line is somehow completely crushing it on the bottom line. This level of outperformance doesn't just demand an explanation, it demands some serious scrutiny.
Exactly. And just look at the divergence right here. This is what I mean when I say financial engineering. Over the last 2 years, revenue grew at a respectable but slowing 6.8% annually. But earnings per share, it exploded at a 20.4% rate. I'm sorry, but that is a massive and seemingly unjustifiable gap. And whenever I see a gap that wide, my first instinct is also to be skeptical. It suggests that the profit growth isn't coming from the core business of just selling more stuff, but from other, well, financial maneuvers. So the question stands, is this real, durable strength, or is it just a house of cards? And here is the magic trick revealed. Over the past 2 years, Core & Main has bought back 8.1% of its own shares. This is a key piece of the puzzle. It's EPS 101. By reducing the number of shares out there, you mechanically boost the earnings per share figure without the company actually having to earn a single extra dollar in total profit. And let's address that head on, because you are partially correct. This is financial engineering, and it is absolutely a part of the story, but it is not the whole story. The lazy analysis stops right here. We need to dig deeper.
This is where we find the real evidence of genuine operational strength, and it's something the market seems to be completely ignoring. Just look at the gross profit margin. It expanded from 26.6% to 27.1% year over year. This is a critical metric. It means for every single dollar of sales, the company's keeping more of it as gross profit, even before you get to things like operating expenses. This isn't a financial trick. This is a direct measure of the core business becoming more efficient and more profitable. They are flexing their operational muscles here.
So how did they pull it off? Well, management spells it out for us. This wasn't luck, it was pure execution. Specific gross margin initiatives are paying off. They're buying their inventory smarter through disciplined purchasing management. And critically, they are holding the line on price instead of just chasing unprofitable volume. This margin expansion is the direct result of deliberate, focused action. This is operational excellence, plain and simple. Okay, I'll give them that. Disciplined management is good to see. But strong margins on flat sales is still just strong margins on flat sales. It doesn't solve the growth problem.
But this does. If you want the ultimate proof of financial health, you look no further than free cash flow. This is the pure, cold, hard cash the business generates from its operations after all of its capital expenditures are paid for. It's the lifeblood of any company. And their margin here jumped from an already strong 13.2% to an incredible 16% this quarter. Cash doesn't lie. A business that is generating this much cash is not a business that's in trouble. This is the bedrock. This is the pillar of strength that's supporting the entire structure. All right. The cash flow is impressive. I get it. But the market invests for the future, not the past. And that brings us to the part of the report that likely caused the entire sell-off in the first place. We need to examine the company's own blueprint for fiscal 2026. This is their forward guidance, and it's where the rubber really meets the road.
And this slide just lays it all out in black and white. There's no ambiguity here. Management's midpoint guidance for net sales is $7.85 billion. Wall Street wanted $7.93 billion. That's a miss. Their guidance for adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, their midpoint is $965 million. The consensus was almost $988 million. That's another miss. You're right. You can't spend this. Management's own forecast for the year ahead is below what the market was pricing in. This is the single biggest, most defensible reason for that stock drop. The company itself is signaling a slowdown.
But context here is everything. Management explicitly states that this guidance assumes flat pricing and flat end market performance. Now, you can interpret this in one of two ways. The optimistic view is that this is a conservative starting point. They're just setting a low bar that they can hopefully clear later in the year. It's the classic under-promise and over-deliver strategy. Or the skeptical take is that they see no growth levers left to pull. They're telling the truth. They genuinely see a tough year ahead, and they're just trying to manage expectations down before things get worse. In a nervous market like this one, the benefit of the doubt always goes to the bears on this. The blueprint they've laid out is for a year of very slow growth, and that's a tough pill for this market to swallow.
Okay, time to put it all together. We've stress-tested the revenue, we've solved the profitability puzzle, and we've examined the blueprint for the future. It is time to weigh all the evidence and deliver the final iron financial verdict.
So let's recap the bull case. Let's build it piece by piece. The foundation is built on an absolutely incredible track record. 16 straight years of sales growth proves this company is resilient. Even in what looked like a really tough quarter, the underlying sales were actually positive once you normalize the data. That massive EPS beat wasn't a fluke, it was driven by genuine operational improvements, things like expanding gross margins, and it's all supported by a gusher of free cash flow hitting a 16% margin. And that cash is then being smartly used to buy back stock. This is the bedrock case. This is the fortress.
Not so fast. You can't just ignore the cracks in the concrete here. The bear case is crystal clear. That jarring headline revenue miss is what people see first. The long-term trend shows a significant deceleration in growth from over 16% down to under 7%. That is a real slowdown, not a mirage. Their own forward guidance was weak across the board. A big chunk of that EPS growth is from buybacks, we proved that, and we saw real weakness in some of their core product lines. These are not trivial risks. They absolutely justify the market's caution.
So, we end where we began. It looks like the market punished the stock for the blueprint, for that weak forward guidance. It sold off on the fear of a slowing future. And in doing so, it seems to be ignoring the incredibly strong foundation. We're talking elite operational execution, expanding margins, and immense free cash flow. These are the hallmarks of a fortress. So the final question is this: is Core and Main a trap for investors who are too focused on that impressive but past profitability while ignoring the very clear signs of slowing growth ahead? Or is it a fortress for the patient investor who believes the market is just panicking over a few surface cracks while ignoring the deep bedrock of cash flow that's right underneath? That's our analysis. The decision is yours. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.